$397 billion. That's the largest cash pile in the 60-year history of Berkshire Hathaway. And the man who built it, Warren Buffett, 95 years old, just sat down in the front row of his own annual meeting on May 2nd, not on the stage. Greg Abel ran the show. And in a CNBC interview that same morning, Buffett looked at Becky Quick and described the current market as a church with an attached casino. That's his words, not mine, but I tend to agree. He said markets now exhibit far more casino-like behavior than they did when he was young, and the prices for a whole lot of things look very silly. He has done this exact move 3 times in 60 years, 69, 99, and 2000. 3 moments where he stepped back, raised cash, took the criticism, and waited. Let me take you back to 1969. Buffett's 39 years old. He writes a letter to his partners, hands back the capital, and walks away from the largest investment partnership of its era. Inside 4 years, the S&P 500 loses roughly half its value through the 1973 to 74 bear market. Now let's jump to 1999. Magazines call him a dinosaur, a man who missed the future. By October 2002, the Nasdaq is down 78% from its peak. Then 2007, the cash builds, the selling accelerates, and 14 months later, the global financial system goes through the floor. The question is not whether we can still trust Buffett's instincts. The question is what he is seeing that the casino is choosing not to see. And to see it, you need a map older than Buffett himself. If you follow this channel, you already know we talk a lot about the 18-year cycle. And in fact, near the end of this video, I'm going to tell you how to get the full free course on it. But before we get to that, let me explain a little bit more about this in detail. This map, this blueprint that we're talking about, was first drawn in the United Kingdom by Fred Harrison and refined in Australia by Phil Anderson. It is sourced from the US public land sale data going back to 1800. That's 220 years of receipts. The shape of it is very simple. 14 years up, 4 years down. The 14 up is split into 2 7-year halves by a mid-cycle slowdown. Average length, about 18.6 years. And the rhythm is unmistakable. Walk the dates back with me. 1818, 1836, 1854 in a compressed cycle. Then we get to 1869, 1888, 1907, 1925 to 1926. Then the Second World War interrupts the rhythm slightly. Then we jump to 1972, 1989, then 2006, 2007. Every single one of those peaks ended in a major recession. Every single trough that followed was a generational buying opportunity. The next number on the clock is 2025 to 2026. Now, I'm not giving you my opinion here. I'm just breaking down the maths of the 220 years worth of data. Now, we built a 7-stage macro investment model on top of this cycle, and the stage we're in right now is the one that matters. Stage 1 is the post-crisis reset. Stage 2 is the expansion. Stage 3, mid-cycle slowdown, finance-led, not land-led, and that's exactly where we lived through in 2022. Silicon Valley Bank, First Republic, those sort of things went down in early 23. Right on schedule, the cycle had drawn 200 years earlier. All of those peaks and troughs happened right on schedule that the cycle had drawn 200 years earlier. Stage 4 is a speculative boom and the easy money. Stage 5 is the peak and the winner's curse phase. That is where we are right now. What does stage 5 look like? Let me give you some concrete examples. You got the Jeddah Tower in Saudi Arabia pushing past 100 stories on its way to over 1 kilometer of vertical concrete. You got NEOM and the Line, the desert mega projects that have already been quietly scaled back. You got Trump declaring this is the greatest stock market in history, while consumer sentiment hits 53. You got Polymarket and Kalshi turning the outcome of every news event into a tradable bet. That's stage 5. Stage 6 is the downturn and the crash. And in stage 6, cash is not trash. Cash today is the #1 holding of arguably the smartest investor alive on the planet. 3 signals are firing right now that confirming the cycle is basically rolling over. Signal 1, the home builders are topping first. XHB, the home builders ETF, peaked in late 2024 and has put in a lower high ever since. The 50-day moving average is sitting under the 200-day moving average. DR Horton peaked in 24, recovered in 25, and is now grinding sideways with lower tops. The NAHB Housing Market Index just printed 34 in April, below the 50 break-even line for 24 consecutive months. This is the same pattern, beat for beat, that the home builders printed between 2005 2006. Signal 2, the US dollar inverts. In the first half of the 18-year cycle, the dollar tends to rise. In the second half, it tends to fall. The DXY peaked in 2022, right on schedule, and is grinding through the mid-90s right now. That is the line that confirms the second half decline of the cycle. Signal 3 is gold. Between July 25 and January this year, the Bank of France repatriated 129 tons of gold from the New York Federal Reserve. In doing so, it booked roughly 15 billion US dollars of capital gain. That single operation flipped the Bank of France from an 8 billion euro loss in 24 to an 8 billion euro profit in 25. Central banks bought 860 tons in 2025, which is the 16th straight year of buying. India's repatriated 274 tons since March 2023. Poland approved 150 more this year. This is the map Buffett is using. He may not call it the 18-year cycle by name, but make no mistake, he is positioned for stage 6. Look at the pattern. $397 billion in cash and treasury bills, the largest defensive position in 60 years of Berkshire's history. And the cash build did not start last quarter. It started in late 2022, the exact moment the second half of the 18-year cycle began. 14 consecutive quarters of net selling, 3.5 years of systematic exit, the longest streak in 60 years. The net equity sales of $8 billion in the first quarter of 2026 alone. That is accelerating, not slowing. And then he walks into the Omaha Arena on May 2nd and sits down in the front row, not on the stage this time. The symbolic handover at the exact stage 5 to stage 6 transition of the cycle has been pointing at it for over a decade. And Greg Abel's first quote as CEO, "I'm not anxious to deploy capital into subpar opportunities." Translation, we are building a war chest. We'll survive the crash and we'll buy the bottom. And honestly, Buffett playing his hand this way at exactly this point in time should be cause for alarm. But we had lots of voices preaching the same message this weekend. On April 27th, Ray Dalio sat down on CNBC Money Movers live television and said the one word every Federal Reserve chair, every Treasury Secretary, and every major Wall Street strategist has refused to say for 18 months, and that is stagflation. No hedge, no potentially, no soft landing caveat. The man who built the largest hedge fund in history by understanding debt cycles and currency debasement looked into the camera and described the present, not the future. He warned that if the next Fed chair yields to political pressure on rate cuts, the credibility of the central bank will be, in his words, severely damaged. In prior interviews, he had used the word brink. He now named the 2026 to 2028 window as the period the United States has to get its house in order before the debt cycle takes the decision out of our hands. CPI accelerating to 3.3%, GDP decelerating to 2%. A federal government spending $7 trillion while collecting $5 trillion. A deficit running at about $1.9 trillion. The national debt at nearly $39 trillion. Interest payments alone hitting $11 billion every single week. Every price stagflation, 73 to 74, 79 through to 82, landed at the exact same place in the 18-year clock. Now, I've been reading your comments about Ray Dalio, and yes, he has underperformed the stock market over this entire 17 or so years to the upside. However, he hasn't been wrong about the macro cycle, looking at the big picture over hundreds of years. So I'm going to take that into consideration when considering what he has to say about the economy, but I'll always look to my own trading and investment plans when it comes to actually making money from the markets. Now, the second voice, and I want to be direct about this before I quote him. I don't like Jamie Dimon, he might be a nice person, but what he stands for with JP Morgan, different story. But there's no one with more insider knowledge about Wall Street's rot. In 2008, the same man told the world that the subprime was contained 3 months before his own bank's exposure detonated across the global financial system. So when the most reliably bullish institutional voice on Wall Street, the man whose entire compensation structure depends on retail investors staying long, says the next credit recession will be, in his own words, the worse than people think, the only honest interpretation is that he is reading something on his own bank's loan book that he has not been forced to disclose yet. The bigger the warning he puts on the record now, the smaller the lawsuits when the losses hit. That's the truth. And it lines up perfectly with the loan book reality. At $870 billion commercial real estate refinancing wall this calendar year, regional banking stress that started during the mid-cycle slowdown in early 2023 and never actually went away. CMBS distress at the highest rate on record, private credit funds quietly halting redemptions, Tricolor and First Brand collapsing into bankruptcy with no public warning. Dimon used the word cockroach to describe what those bankruptcies signal. When you see one, there are always more. The third voice has the cleanest track record on this exact setup. Gary Schilling, the economist who called the 2007 housing crash before the consensus even understood that housing could fall. Schilling has just published his forecast, a 20 to 30% correction in the S&P 500 by year end 2026. Not next cycle, not eventually. He's saying this year. His reasoning, valuation compression from 21 times forward earnings back to the historical mean of 16. AI capital expenditure failing to translate into broad-based productivity, consumer credit unwinding through delinquency data already on the tape. 20 to 30% is the average peak to trough drawdown of every prior stage 6 in the 18-year cycle going back to the 1950s. Now, I don't know if Schilling is formally taking into account the 18-year cycle here, but he is pricing it perfectly anyway, almost perfectly. Now let's quickly go over all of these. Buffett sitting at $397 billion of cash. Dalio giving the US 2 years before the stagflation destroys the economy. Dimon confessing credit is about to collapse. Schilling calling for a crash this year. And Howard Marks, who in his April memo from Oaktree drew an explicit parallel to his 2007 memo, the one written on the eve of the global financial crisis. And Sarah Breeden at the Bank of England describing global stocks as too inflated. Add Goldman Sachs raising recession odds and using the word froth, which, by the way, is a word they hadn't used in formal printed documents since October 2007. The Buffett Indicator is at 228%, total US market capitalization equal to 2.28 times the entire annual output of the United States economy. The previous all-time extreme was 216% at the dot-com peak. Forward price to earnings at 21 times, among the top 3 readings in the last 100 years, alongside March 2000 and December 2021. Consumer sentiments at 53, the worst non-recession reading since the survey records of 2001. Every single one of these data points belongs in stage 5 of the 18-year cycle. None of them belong anywhere else. So what do you actually do? Move one would be to audit your cash percentage. Buffett is sitting on roughly 30% of his deployable capital in cash and treasury bills. The man whose entire 60-year career was built on the idea that equities are the best long-term store of wealth has chosen to hold a third of his firepower in dry powder. So ask yourself, am I comfortable with my exposure to risk right now? The people who survive crashes are the ones who decide their cash position before the crash, not during it. Once panic starts, the decisions get made for you. You get your margin calls, forced liquidations, frozen brokerage accounts, the list goes on. That's a decision you need to make today, or at least a question you need to start asking yourself today. Move 2, watch these 3 signals every Friday. XHB and the home builders holding that 2024 top. The dollar at 96, a breakdown opens a door, a break back above 100 means we need to reassess. Home builder earnings momentum is stalling, squeezed margins, analysts trimming forecasts, and so on. Looks like the capital's rotating out at this point. 5 minutes a week, that's the entire job. When 2 of these 3 signals trigger, stage 6 is no longer a forecast. We're underway or very close to that. The order matters. Home builders top first, stocks top second. Gold typically confirms the trend. Right now, we are sitting in the window between signal 1 and signal 2. Then we go move 3. Build the watch list for 2029 to 2030. This is the part nobody talks about. Stages 7 and 1 of the cycle, the stagnation and the repair, then post-crisis reset, have historically delivered the buying opportunity of a generation. The 1932 low, the 75 low, the 1992 low, the 2010 low. The most fearful, most hopeless moments on the chart. Every single one of them rewarded the people who walked in with a list already prepared. The trough of this cycle on the 18.6-year maths lands somewhere around 29 to 30, possibly into early 31. The work you do in the next 18 months defines the next 18 years of your portfolio. The playbook is not complicated. And I'm not telling you what to buy or sell here. That depends 100% on your risk appetite and how you personally see this stage of the cycle developing. That said, historically speaking, there are some interesting sectors that you might consider looking into. Physical gold, maybe physical silver, we'll talk about that later. Productive land, quality businesses with real cash flow at distressed valuations. Look into energy, look into food, look into things people will keep paying for even if we go into a recession. Look into things that cannot be frozen, cannot expire, and cannot be diluted by a central bank press release. And if you want to know the exact levels we're watching, the timeframes, the warnings, the alerts I'm setting up, I'm sharing all of that and more in the latest TIA course. There's 3 videos, all for free, tons of alpha, no fluff, no nonsense. There's a link in the top of the video description. Other than that, that's it for me today, guys. Have a fantastic day, take care, and until next time, peace out.